Good day, everyone. Welcome to the 13th lesson of Chapter 6. Today we delve into an intriguing subject, the reality of trading Forex with just $100. Over the next few minutes, we'll navigate through 7 key points that shed light on this unique journey. We'll examine the practicality of starting your trading portfolio with a modest sum of $100 and the impact of such an initial deposit on your trading potential and risk exposure. We'll also explore the increased risk associated with using leverage with small deposits and the potential for quick account depletion due to market volatility. Furthermore, we'll emphasize the importance of managing expectations and risks and the need for effective risk management strategies. Finally, we'll learn from trading scenarios to better understand the implications of trading with a small account balance. So, without further ado, let's dive into the first key point, starting with $100. We begin our journey with a modest sum of $100. Imagine it as a small seed from which a mighty tree may grow. But let's not get ahead of ourselves. The practicality and advisability of starting Forex trading with $100 is a topic that warrants a thoughtful discussion. First, let's put things into perspective. $100 is indeed a humble sum, especially when you consider the vast and volatile world of Forex trading. It's like stepping into an ocean with a small raft, where the waves represent the fluctuating currency values that have the power to toss your raft around. Now, is it possible to navigate this ocean successfully with just $100? Absolutely. But it's important to remember that the journey will be fraught with challenges. The most significant challenge is the limited trading potential. With $100, your trades will be small, and so will your profit margins. But remember, every successful journey begins with a single step. And in the world of Forex, that first step could be a small but strategically placed trade. Further, starting with a modest sum also offers a unique opportunity. It allows you to dip your toes in the water without risking a significant amount of your hard-earned money. You get a chance to understand the mechanics of the market, develop your trading strategies, and learn from your mistakes, all while keeping your risk exposure to a minimum. But let's not sugarcoat the reality. Trading with $100 also means that your account is vulnerable. A few missteps could result in the depletion of your funds. This is why it's crucial to approach Forex trading with $100 with a clear understanding of the challenges and a solid plan to navigate them. In conclusion, starting Forex trading with $100 is like embarking on a thrilling adventure. It's a journey that promises learning, growth, and potential rewards if navigated wisely. Now that we understand the starting point, let's explore how our initial deposit impacts our trading. The size of your initial deposit plays a significant role in your trading journey. So, let's get into it. Imagine your initial deposit as the foundation of a building. The larger the foundation, the more robust and stable the structure. Similarly, a larger initial deposit provides a stronger base for your Forex trading, enabling you to withstand market fluctuations and volatile periods. Now let's talk about buying power. Picture this: you're at an auction, and the amount of money you brought determines how many bids you can place and how high you can go. In Forex trading, your initial deposit is your buying power. It dictates how many trades you can open, and more importantly, how much risk you can absorb. A larger initial deposit increases your buying power, giving you more room to maneuver and more opportunities to profit. It allows you to spread your investments across various currency pairs, reducing your risk exposure. On the other hand, starting with a smaller deposit, such as our hypothetical $100, limits your buying power. This constraint means you can open fewer trades and have less room to absorb losses. Your risk exposure is heightened because a small change in the market can significantly impact your account balance. Yet, it's not all doom and gloom. A smaller initial deposit can also serve as a valuable learning tool. It forces you to be meticulous in your trade selections and diligent in your risk management. It compels you to understand the market dynamics and to make informed decisions. It's like a training ground, where the stakes are not too high, but the lessons learned are invaluable. However, always remember this: regardless of the size of your initial deposit, your success in Forex trading is not solely determined by the amount of money you start with. It's also about your trading strategy, your understanding of the market, and your ability to manage risks effectively. With that understanding, let's delve into the relationship between leverage and risk when dealing with small deposits. Leverage can be a double-edged sword, especially with small deposits. In the world of Forex trading, leverage is often seen as an attractive feature. It's a tool that allows traders to handle larger positions than their initial deposit would ordinarily permit. However, while leverage can amplify potential gains, it can equally magnify losses, making it a risky venture, especially when dealing with small deposits. Think of leverage like a magnifying glass. It can help you see bigger, but it can also make the sun's rays more intense. With $100 in your trading account, using leverage to take on larger positions can seem like an attractive proposition. It's like being given the keys to a powerful sports car when you've only ever driven a compact. The thrill is enticing, but the risk of crashing is considerable. Let's break it down. Suppose you decide to use a leverage of 100 to 1. This means that for every dollar in your account, you can control $100 on the Forex market. On the surface, this seems great. You've just turned your $100 account into a powerful $10,000 trading tool. However, the catch is that the losses are also amplified. A minor market fluctuation against your position could lead to significant losses, potentially wiping out your small deposit. It's essential to remember that the market does not discriminate between large and small deposits. It moves as it will, and if you're on the wrong side of that movement, your account could take a hit. Furthermore, brokers require a certain margin to maintain open positions. If your losses push your account balance below this margin requirement, you'll receive a margin call, and your positions may be closed automatically, locking in your losses. With this knowledge of leverage, we can now contemplate the potential for quick account depletion. It's important to manage leverage judiciously, understanding that it amplifies both potential profits and potential losses. Use it wisely, and it can be a powerful tool. Use it recklessly, and it can lead to a quick end to your trading journey. A small trading account is like a tiny boat in a volatile sea. This analogy perfectly captures the essence of the potential for quick account depletion when trading Forex with $100. You see, when you're navigating the tumultuous waters of the Forex market with a small trading account, every wave, every ripple, can have a significant impact. The same way a small boat can be easily tossed about by the sea's whims, a small trading account can be rapidly depleted due to market volatility. So, what does this mean for you as a trader? It means that your $100 account is vulnerable to the market's unpredictable swings. A single unfavorable trade can take a significant chunk out of your capital. A series of unsuccessful trades could potentially wipe out your account altogether. Consider this. A single pip movement in the Forex market may seem insignificant, but if you're trading a standard lot, which is 100,000 units of a currency, a single pip movement can translate to a $10 change in your account. Now, with a $100 trading account, a $10 change is a 10% impact. A few unfavorable trades, and your account could be in serious trouble. But don't let this scare you off. This potential for quick account depletion isn't meant to discourage you. Rather, it's a reality check. Knowing this vulnerability exists is the first step in mitigating it. It's about understanding the sea you're sailing on before you set sail. It's about recognizing that while the Forex market offers vast opportunities, it also poses significant risks, especially for small accounts. So, how do you navigate this volatile sea with your tiny boat? You do it with caution, with strategy, and with a healthy dose of respect for the market's volatility. You do it by not over-leveraging your trades, by setting realistic profit targets, and by employing effective risk management strategies. Understanding the risks, it's time to manage our expectations and risks. Because in the world of Forex trading, understanding and managing risks isn't just part of the game. It's the key to survival. Cautious trading and realistic expectations are key when starting with a limited budget. In the world of Forex trading, it's easy to get swept up in the allure of quick gains and high returns. But when you're starting out with just $100, it's essential to keep your feet firmly planted on the ground. So, let's talk about managing expectations. First, understand that Forex trading isn't a get-rich-quick scheme. Yes, there's potential for significant profits, but there's also a substantial risk of loss, especially when starting with a small deposit. It's a game of patience, discipline, and strategic decision-making. You might be wondering, how much can I realistically expect to make? Well, that depends on a variety of factors, including your trading strategy, market conditions, and risk tolerance. But as a general rule of thumb, aiming for a monthly return of 1 to 3% is a realistic and sustainable goal for many traders. Now let's shift our focus to the importance of cautious trading. The Forex market is unpredictable and volatile. As such, it's crucial to trade cautiously, especially when your initial deposit is small. This means not risking more than a small percentage of your account on any single trade. Typically, experts recommend risking no more than 1 to 2%. In addition, it's crucial to stay disciplined. This involves sticking to your trading plan, not letting emotions drive your decisions, and knowing when to cut your losses. Remember, in Forex trading, discipline often trumps intelligence. Moreover, patience is a virtue in Forex trading. It's about waiting for the right trading opportunities and not forcing trades. It's also about understanding that building wealth through Forex trading takes time. You won't double your account overnight, and that's perfectly okay. In conclusion, managing expectations and risks in Forex trading involves a blend of patience, discipline, and cautious trading. It's about setting realistic goals, making strategic decisions, and understanding that success won't happen overnight. Having set our expectations, let's talk about risk management strategies. Risk management is the backbone of successful Forex trading. The reality of trading Forex with a modest sum of $100 comes with its fair share of challenges. However, these challenges can be mitigated by employing effective risk management strategies. Let's delve into some of these strategies. Firstly, we have the stop-loss order. This strategy involves setting a predetermined level of loss at which a trade will be closed. It's like a safety net, keeping your losses within a manageable limit. You might be tempted to let a trade run in the hope that the market will turn around. But remember, hope isn't a strategy. Stop-loss orders help you trade with discipline and protect your capital from significant downturns. Next, consider diversification. It's an age-old adage, don't put all your eggs in one basket. In Forex trading, this means not tying up all your capital in a single currency pair. By spreading your investments across multiple pairs, you reduce the risk of a single trade decimating your account. Diversification not only spreads the risk, but also increases the potential for profits from different market movements. Another strategy is position sizing. This involves determining how much of your account to risk on each trade. A common rule of thumb is to risk no more than 1 to 2% of your account on a single trade. This approach ensures that even a series of losses won't wipe out your account. Lastly, there's continuous learning. The Forex market is dynamic and ever-changing. To stay afloat, you need to constantly learn, adapt, and refine your strategies. Analyze your trades, learn from your mistakes, and never stop improving. Remember, risk management is not about avoiding risks. It's about understanding and managing them effectively. While these strategies can't guarantee profits, they can help safeguard your modest investment and increase the chances of long-term success. Armed with these strategies, we can now learn from trading scenarios. Learning from scenarios is an effective way to understand the implications of trading with a small account balance. Let's delve into a couple of hypothetical situations to illustrate potential outcomes when trading Forex with $100. Our first scenario involves John, a novice trader. He jumps headfirst into the market with his $100 without a concrete trading strategy. He's lured by the prospect of making quick gains and decides to trade using high leverage. Unfortunately, the market moves against him and he loses his entire investment in a matter of days. A harsh lesson, but one that underscores the importance of having a risk management strategy in place. Now let's consider Sarah, another trader starting with the same amount. Unlike John, Sarah understands the value of a well-thought-out trading strategy. She decides to use minimal leverage, and she's prepared to accept small losses in the pursuit of long-term gains. She also sets a stop-loss limit to protect her investment. While her gains are not astronomical, they are consistent, and she manages to grow her account over time. Sarah's scenario demonstrates the importance of patience and the power of a well-executed trading plan. In both these scenarios, the initial investment was the same, a modest $100. However, the outcomes were drastically different due to their approach to trading and risk management. These scenarios underscore the need for a cautious approach to Forex trading, especially when starting with a small initial deposit. It's crucial to understand that while the Forex market offers the potential for high returns, it also comes with substantial risk. A well-thought-out trading strategy, patience, and effective risk management are vital to success in this volatile market. With these insights, you're now better equipped to navigate the world of Forex trading with $100. We encourage you to continue on to the next lesson, understanding margin calls and stop-outs with different brokers.